Dr. Kenneth B McEwan, Assistant Professor of Finance at Grace College in Winona Lake. Can everybody see the screen with the title of the presentation?
Yes, yes.
Okay, great. Winona Lake, Indiana is about 200 kilometers east-southeast of Chicago, right in the northern part of Indiana, in case you're wondering where that is. And my study was on the financial impact of using euro call options to hedge accounts receivable. Yeah, let's page down here. On the introduction basis, international business has grown rapidly. And hold on just a second, I'm going to put my timer on. Time myself as well. International business has grown rapidly in recent years. In 2020, the United States had global trade of approximately 5 trillion, 2 trillion in exports, 2.8 trillion in imports. Companies are looking to expand their supply chain opportunities through engineering, production, and cost reduction opportunities. When you enter into these contracts, you may be creating a foreign currency exchange rate risk. Oftentimes, the party with the biggest party in the negotiations is the one that can dictate what currency has to be paid. And this exchange rate risk can be hedged. So my study looked at answering 2 questions. First question was, is the euro-US dollar exchange rate risk, is there a risk in 60 days of accounts payable? Look, 60 days is about the normal time of accounts payable. And the question was, is there exchange rate risk within those 60 days? Question 2 is, would the use of a euro currency option to hedge this risk be financially beneficial? The euro-US dollar is a most highly traded currency pair. I used data from 2007 through 2019, data from the Federal Reserve, and I focused on, again, the 60-day fluctuation. And on the currency call options, the data is from 2007 through 2016, and I used actual option pricing data, not theoretical. This is helping to close some research gaps. First research gap is the limited time periods when it's studying exchange rate, and that's usually limited on duration. And oftentimes my research showed that a lot of studies have been done over a 2 or 3 year time frame, but not a long time frame of 13 years that I used. Oftentimes researchers use theoretical option prices as opposed to actual option prices, and they use focus on equity options and not exchange rate options. This study was intended to reduce those research gaps. I used 13 years of euro-US dollar currency data and 10 years of option data. Again, I used the euro-USD and a statistical analysis. And I used Minitab and Excel. No changes were made in the software. Here's a histogram of the 60-day change in euro-US dollars. And it shows that it fairly closely resembles a bell-shaped curve. So in other words, the bell-shaped curve is here in the red, and it shows a fairly consistent with the bell-shaped curve. This is a change in 60 days. So what that means is, for example, the worst case scenario was a 12% increase in the euro within a 60-day time frame, 12% increase in a 60-day time frame. So that'd be a 12% increase in a payable happened within 60 days. That could be a major impact on a company. And you can see also we've got some couple of instances where we have what we call long tails. Unusual events happen. The statistics on the data, the standard deviation was 3.83% over that time frame. The maximum appreciation of the euro during that time was 12%. The minimum of the depreciation of the euro was 15% over that time frame. And the average Euro USD exchange rate during this study period was 1.27. In other words, it cost $1.27 to buy 1 euro. That was the average over that time frame of the study. Also looked at hedging with options. The paper examined the use of euro call options to hedge the payable. The call option data was from January 1st, 07 through the end of December of 2016. When picking the option, I picked the option with the strike price closest to the spot price at the time the option was purchased. So if the euro was costing 1.30, I would pick the option price. I would pick the option with the strike price closest to 1.30. I also picked a maturity closest to the 60-day maturity. So options trade on the Chicago Mercantile Exchange or within the CME group. They trade on certain days of the week, certain days of the month. So you have to pick the option that's closest to that. So you couldn't actually get one that's 60 days every single time. The premium is market-based. I obtained the data from the CME group. The premium is how much it costs to purchase that option. Overall, 49% of the call options would be exercised. That reflects the overall euro depreciation during this time. So typically on options, about 50% of them are exercised, which is, so my study aligns with historical analysis. Overall, if you hedged every single position, in other words, every time you had an accounts payable introduced during this time, so that would be every single day basically for the study, the overall loss on the hedge position is 0.4% versus a 0.3% gain on the unhedged position. So this study included the premium. Lots of studies don't actually include the cost of the hedging. So this study does include the cost of hedging. So the hedging cost about 0.7%. However, if you hedged the position, you would avoid 241 instances where you had a greater than a 5% loss. So what you can do with, we see with hedging, is that you are smoothing out results of the financial implications. So again, this is looking at an accounts payable and how that could change over a 60-day time period. The next slide shows the premium, the average premium for buying a euro premium in US dollars per euro of hedge. The interesting thing about this chart is it definitely shows that during the Great Recession, which started in 08 and basically went through 09 in the US, you can see an increase in the price of the options. In other words, this aligns with option pricing theory, which says that the greater the volatility in the marketplace, the higher the cost of the option. And then you can see a drastic increase in the 08 through 09 timeframe in the price of the hedge. And then price started coming down, and we went into the timeframe of the European debt crisis. And you can see the option prices started going back up. And then as we move out of that high volatility time frame into the 2013 through 2016, you can see that the option prices settled back down to a normal about 2%. So it costs about, in a normal time frame, it costs about 2% to hedge, to create the hedge, an option hedge in per euro of hedge. On the summary of findings, does the 60-day fluctuation of euro US dollar exchange rate justify the consideration of taking actions to address the currency risk? The findings do suggest that the euro US dollar exchange rate fluctuates enough to at least give it some consideration. So I would suggest anybody in supply chain who is negotiating with, let's say you're in the US and you're negotiating supply chain in Europe. You should at least talk to your finance heads to make sure that you're at least considering hedging that risk. The question number 2, would the U.S. use of euro currency call options hedge this risk be financially viable? Overall, there's a negative net transactional cost. In other words, it costs more to hedge than it does not to hedge. And that reflects basically the cost of the hedge. However, as we've seen with most studies involving hedging, the hedging would have avoided some big fluctuations. And I could see a program manager being quite upset if he had to pay 12% more cost over a 60-day time frame. That could really be harmful to a contract if the worst case scenario is a 12% loss. And also you can avoid the 8.7% of the transactions had a greater than 5% loss. So again, currency hedging instruments allow a company to better manage risk and predict cash flow and earnings. And also, studies have shown that a firm with a well-constructed currency management plan is able to better predict its financial ability, and you may be able to negotiate better banking relations. So I did not look into that particular issue. Recommendations for future studies. Again, this one looked at the euro versus the dollar. Again, that's the #1 traded currency pair. Additional research in the movement of other currency pairs could be added to the research, and I think that would be good to look at how much other currencies such as the dollar, the yen, or the yen, the euro, to see if there's risk in accounts payable there for other currencies. And the criteria of the currency option selection could be varied. In other words, I picked the currency option with right on spot and the spot price, and I picked the option with the strike price closest to the current spot price, just to make it simpler. But you could pick a current option with different currency, different spot prices. Okay.